Hi folks, Rob Flux here from Property Developer Network, coming to you for another Sunday session. This week's topic is how to get yourself deal ready. Now, normally I don't do presentation slides, normally I'm just talking off the cuff, but in our current environment at the moment, I thought it would be worthwhile giving you a little bit of an insight into my view of the market and why I think that there are actually deals coming. And because there are deals coming, I want you to prepare yourself for those deals and get yourself deal ready. So let's have a look at what is actually happening in the market. And of course, the topic of the week is COVID. And if we have a look at COVID, clearly there's plenty of stuff happening around the globe. These are some stats I took a couple of days ago, just 2 days ago, and the total deaths at that point, total confirmed cases at that point were 537,000. Now have a look at what has happened in just 2 days. So I've taken these stats 2 days ago and now today. So that has jumped up to 664,000. So you can see that the climb, I guess, on a global basis is quite significant, as are the number of deaths and also the number of recovered people. What you'll see here from a statistics point of view, number of deaths is around 4% of all of the infected people so far globally. And we're at about 21% of the people that have been infected that have actually now recovered. Now let's compare that to Australia. Now, if we have a look at Australia specifically, this again, this was Australia 2 days ago, 3,143 cases. And now 2 days, you see that the climb is actually occurring. But what is interesting here from a statistics point of view is that our total deaths is 0.004%. So we're 1/10 of the percentage rate of the world from an infections point of view, from a deaths point of view. But also the recovered, we're not quite in the same percentile with the recovered as well. We're quite low in the recovered, which tells me that we're still in the early stages of this. And I think what the Australian government has done with locking us down in a short, sharp way has actually helped to hopefully contain what this is going to be over the longer term. Now, having said that, this is obviously going to have massive impacts on the market. So let's have a look at what it's actually having a look at the market. So late last week, we had this particular news article that says that it was wreaking havoc on our economy, and understandably so, but that housing prices are holding up for now. And I want to walk through why the housing market is holding up so that everyone's got a good indication as to what are the sorts of things that are the indicators and drivers behind the property market. So firstly, let's have a look at the All Ordinaries Index. So this is the share market, and you can see that the share market has taken a massive dive in recent days. But why is it that the property market is holding up? And we'll come to that in a moment. What I do want to say is that this is not the only time that this has happened. Now, clearly, this is, I guess, the first time we've had a pandemic in modern days, but there have been pandemics in the past. But the ability to spread them so rapidly with air transportation, that sort of thing, is very different. But if we have a look, for myself personally, I've been through 3 different market crashes. So I've been through the recession that we had to have, the Y2K millennium bug, and the GFC. And what I've learned from my process is that we can learn from history. And if we don't learn from history, we're doomed to repeat it. And by that, what I mean is we know that the crash is coming. We can predict the crash is coming. We can't predict how quickly it's going to happen. We can't predict how deeply it's going to happen. And we can't predict how long it's going to take to recover. But what we can say is that it will recover. And we can say that because when we look at all of the other market crashes that have happened over time, we do eventually recover. Now, for each one of these crises, it's taken anywhere from a year to, I'm going to say 7 odd years for it to actually recover, depending upon the significance of the crash. And some of them were even as little as 6 months. So the point of it being that the crash is going to occur, so we need to prepare ourselves for that crash. But in doing so, and being in the property market specifically, what I want to do is show you this graph, which is a very interesting cross-reference between the Australian ASX 200 price index and the core logic dwelling price index. And what we can see is that where there are peaks in the market, there is a delay between, so this is the share market, and there is a delay between that peak actually occurring in the property market. Similarly, that when there's a trough, there's also a trough. So the share market is a lead indicator. But what is significant is that the property market, when it happens a little bit afterwards and doesn't get impacted as much. So where we've seen that massive share market crash, and I'm going to say that there's going to be a little bit more to come, we can predict that the property market is equally going to crash, but not by as much. And so in knowing that that's the case, now is the time to prepare ourselves for that. So, and then inevitably we know that it's going to come back. So we want to get ourselves deal ready for when it does inevitably come back. So a lot has happened in a single week. So let's have a look at what has actually happened. First of all, pubs, clubs, and restaurants were announced to be closed on Sunday. Now, when that happened, there were a significant number of jobs that were lost in one foul swoop across the board. I was not immune to this. I actually had a property that was due to go unconditional on Monday, and the purchasers of that property happened to be working in the hospitality industry. So they lost their job on Sunday, which meant that Monday they could not go unconditional. Unfortunately, that's going to happen. We need to be prepared to know that those sorts of things are going to happen in the current market, and anticipate, well, what if this does happen? What is my break-even point, and what am I going to do? What's my next step? So start planning now so that if it does occur, then you've got some ability to go back and forth with that vendor, or go back and forth with other vendors, or maybe withdraw it off the market because you've assessed your situation. And that's really what today is all about, is how to assess your circumstance. So on the back of this was Sunday's news. So auction clearance rates were starting to tumble amid fears of the virus. Now, at this point in time, the auctions were actually still open, but the clearance rates, which is again an indicator of how robust and nimble the property market is at this point in time, they were starting to not show sales as quickly last weekend. Now, what happened a couple of days later is that the auction houses were then actually banned. So now you can't even do an open home nor an auction, but there are a number of real estate agents that are now doing online auctions, which is a good way of actually being nimble in the current market, because people still need to actually sell. But this was Tuesday or Wednesday of this week that was actually announced. And then by Friday, this news was out saying that thousands of auctions have been pulled, and the property market is starting to drop. Now, if you've been following me for a couple of weeks, you would have seen that I've been saying for a couple of weeks that this is inevitable as part of the process. And so you shouldn't have been surprised that we are where we are. But what I would say is be alert but not alarmed. It's not yet time to panic. It is time to prepare. Now, because of the number of job losses, because people are struggling to actually pay their mortgages and that sort of thing, we're seeing a lot of movement in the market with things like this. There are people doing petitions saying to rent strike. There are, I guess, tenants that are saying, look, I can't afford to pay anymore. There are people with mortgages that can't afford to pay the mortgage. And so there's a lot of momentum at the moment, and putting a lot of pressure on the government, saying, hey, we need some sort of moratorium or freeze on both rents and mortgages. And what I'm going to say to you is be careful what you wish for, because they may actually have a bigger impact than what you anticipate. So I guess coronavirus is, because of the impacts, there's a lot of mortgage stress happening. So it's not just the rent stress, but it's actually the mortgage stress itself. And what is really interesting is this message has clearly gotten to the government at this point in time, because on the 27th, the Prime Minister actually put a press conference out where he mentioned that rent freezes and mortgage freezes are on the agenda for the next stimulus package that they're putting together right now. So they're working on it right now. What that is going to be, we don't really know. We know that what they're going to do is treat commercial and residential slightly differently, because commercial is keeping business afloat and residential is keeping a roof over people's head. So I'm anticipating that the way they treat those two particular segments of the market will be different. So watch this space. Now, having said that, Prime Minister has very categorically said that we are not going to just copy and paste what has been done in other markets. So let's have a look at what has been done in some other markets. So the global approach to the rental and mortgage assistance. If we have a look at the USA, the USA has put no moratorium on mortgage repayments, okay? Now, there is a couple of asterisks there, because there are some government-backed mortgage lenders that got hit by the GFC last time round. So those guys will potentially have some things in place, but all the rest of the banks won't. Evictions have been suspended, particularly in public housing, but not in the rest of the community, and rents have not yet been frozen. If we have a look at Singapore, so Singapore again hasn't done any mortgage freezes or repayments, but the banks themselves are starting to do that on their own reconnaissance rather than being government backed. But evictions have been suspended, which means that if people aren't able to pay their bills, they're not actually being kicked out, but their rents have not been frozen, meaning that their rent is still accumulating. Now, Canada, they have done the moratorium on the mortgage repayments and some eviction notices in place, but not all, but they have not frozen the rents. So basically what they're trying to say is, if you can pay your mortgage, then you should continue to pay your mortgage. If you have a tenant that can't pay your mortgage, then in that particular instance, you have an option to actually trigger that mortgage moratorium. Sorry, tongue-tied at this point in time. So you can actually do that if you so choose, but if you can keep paying it, you should keep paying it. Now, why would you say if you can pay it, you should pay it? And what I'm going to say is the moratorium on mortgage repayments is actually a devil in disguise, because whilst it stops you paying your payment right this very second, it doesn't actually mean that money is not due. What they instead do is they capitalize that back into the loan in one of two ways. So it's either tacked on at the end of the loan, or alternatively, it's amortized over the length of the loan. The challenge there is that if we have a 6-month delay or moratorium on our repayments, that may add anywhere from 3 to 6 years to your loan, because that interest is then interest on interest on interest over all those years, which can then add up. So we want to be very careful with that. The UK has done the mortgage freezes and eviction suspended, but not looked after the rent. Australia, so far, nothing. But watch this space. That is coming next. And France have gone all the way to, I guess, nobody gets evicted, rents are frozen, and mortgages are frozen as well. What I would say to you, though, is, I guess, watch this space. But at this point in time, I would highly encourage you, whilst they're trying to have a look at what it is that they're going to do, now is the time to actually start to lobby your local member and say, look, I'm a mortgage owner, and if you freeze my repayments, that's fantastic. That's going to help my cash flow right now. But it's going to add anywhere from 3 to 6 years onto my loan. So that's not really helping me in the long term. It helps me in the short term, but doesn't help me in the long term. So if they're going to do that, what I'm going to say is what they want to do is a complete and utter pause, which means that your loan is actually frozen, as opposed to just your repayments not due. Or not meant to be paid right now. That's my encouragement to you, is go lobby the current member that represents you in your area and say to them, this is the feedback that I want in there. Now, I understand rent freeze. I also understand the moratorium, but really what I think they want to do is just put a complete and utter break on everything and freeze that per se. So that said, that's what I think is coming in the next week. So watch this space for that particular one. Now, in saying that, when we actually have a look at what is happening in the market, the property market is slowing down. So if we have a look at the number of buyer inquiries, this is a survey that CoreLogic did to a number of their real estate agents. 395 respondents, and what they've said is that 34% of them, or thereabouts, have seen a drop in the number of inquiries by more than 50%. Okay, there are about 30% that have said relatively steady, but if you add up the number, so we've got 6% that says it's down by 10, we've got 10% that's down by 10 to 25, we've 20% that say it's down by 25 to 50, and 34% saying 50%. When you add all of that up, that's a very, very dramatic slowdown in the number of inquiries. Now, at the moment, it is not yet reflected in price drops, and I want you to note that. So this is basically people going, well, we don't know if we're going to have a job right this very second, so we're not going to go into a mortgage unnecessarily. So that anything that was an optional spend, what they're doing right now is to say, okay, well, I'm not going to do that optional spend. If I don't need that brand new house, now is not the time to do that. And so what you're seeing is just a slowing of the amount of inquiries, but it has not yet reflected in the price dropping. Now, watch this space, because I think that will soon be reflected in the price drops. Equally, seller inquiries have also dropped. So with seller inquiries dropping, this is the number of people actually wanting to list properties for sale. This is sellers who, I guess, may want to sell, but understand that they're coming into a bumpy period and they don't want to be panic selling. So what they've done is to say, well, I'm actually going to remove that stock from the market at this point in time. I'm not going to put it on the market because I don't think that those buyers are going to be there even if I did. And if they did come on en masse right now, then I think that would get into a panic situation. So it's actually quite good that the number of people listing has dropped at the same time as the number of people inquiring. And that's to be expected. But as I said, this is a delay from the share market dropping. Then you see the people losing their jobs, and then it's going to have this slow trickle effect. And eventually it is going to hit us. And there's going to be people who will have to sell, unfortunately. They're going to be people in sticky situations that unfortunately will have no choice. When the first one or two of those come on at this moment in time, so if you're in that boat at this moment in time, if you put it on right now, at the moment your prices are relatively stable, but your number of inquiries are dropping. So you want to be very careful there to say, well, if I put it at the right price point and the right buyer is there, then it may actually transact. Now would not be the time to get greedy. But what I would say is inevitably there are going to be people that will sell just because they need the cash flow. And that's unfortunately going to mean that the prices are going to drop, which then is going to start a little bit of a daisy chain effect. So know that that is coming. So be prepared. Know that those inevitable impacts on our economy are actually on the way. So as there are less people out and about spending money, and I went to the shops today for some essentials, and I couldn't tell you how much space that I had around me. There are so few people actually out on the roads. There are so few people actually out in the shops. So as people are less out and about spending money, that means that there are less businesses receiving money. As less businesses receive money, then they're going to struggle with the income streams. They're going to struggle with being able to keep people employed, which then is going to have a daisy chain effect. And so there's going to be another round of people losing their jobs. Now, unfortunately, this is really the circumstance. And again, I'm not immune here. My wife, unfortunately, or fortunately, we own a massage clinic. We've been forced to shut down, and all of the therapists who work within that business no longer have an income stream. That is then going to flow onto, well, they can't go out and spend in the economy, which means that the businesses that they were going to spend in then start to struggle as well. So it's going to have this daisy chain effect, which is why the government putting all of the stimulus packages in that they are doing is trying to prop up the market as much as humanly possible. But financial distress is coming. So what that means is that people are going to start to sell their assets, including property. So right now they're selling their share assets because they're very liquid. And for most people would have shares that are in the tens of dollars, whereas property they tend to have in the hundreds of thousands of dollars. And so it's not as liquid an asset, whereas shares are much, much more liquid an asset. So that's why they tend to get transacted much, much quicker. Unknowledgeable people will panic. So my guidance to you is please don't be one of them, okay? Know that I guess it is going to be challenging. And I'm going to say, is a recession coming? I'm going to say, firstly, you need to understand what a definition of recession is. So 2 consecutive quarters of negative GDP in a row. Now, I'm going to predict that that is almost inevitable, okay, that we're going to have 2 negative quarters of GDP because this particular quarter has already been smashed, and I don't think that we are going to recover in the next quarter. So that said, almost certainly that we are going to have a technical recession happen. What I can say though is that right now interest rates are at record lows, okay, which means that because of that, the government doesn't have much ammunition to kickstart the economy. What they generally do is they drop interest rates, which then encourages people to go out and actually spend money. They've got more access to funds, so they go out and actually spend money. Now, we're at the point of having a 0.25% basis point, which means that we are very close to the fact that we are going to have 0 or even negative interest rates. Now, negative interest rates gets really, really interesting, which means that any money that you have sitting in the bank will actually charge you for holding it in there. What they're trying to encourage with negative interest rates is for you to take the money out and then go and actually spend it. So I'm going to anticipate that negative interest rates are very likely in the not too distant future to try and kickstart our economy. I think that the government is going to hold off on that for this point in time because that will cause all sorts of panic, and they want to try and leave that to the point where we're actually in the recovery mode and trying to kickstart and get people out there and spending again. So there's lots of stimulus packages being rolled out. So there's been 2 stimulus packages rolled out already, and I know that there will be a 3rd one that will come out. I'm going to say probably Tuesday or Wednesday of this week is my prediction, and that's going to be around those rent rolls and also the mortgage and how and what's actually going to be there to assist the property market and keep the property market up, because the property market is one of the key drivers to our economy. So people building homes, people I guess upgrading. We've got massive population growth that is actually in there. So be very, very mindful. But what I would say is that I guess the world is being impacted, not just Australia. So whilst we can contain the virus to an extent, and whilst we can contain the amount of job losses and the impacts from people actually getting sick in that regard, unfortunately, some of our supply chains in and out of the country are also going to slow down. Now, I note that they're not going to stop. My guidance on that would be that where there's suppliers that are coming from other countries, obviously they've got unemployment issues going to happen there. So there's going to be some businesses go out of production over there. But the suppliers that are being created, most of them come to Australia via ship. And because they come via ship, it means that by the time they get here, they've been at sea for at least a week. So by the time we quarantine that for another week or so, we should still be able to get that through our gates relatively quick. So the government's going to treat supply chain and human trafficking, and I mean that in the nicest sense, not as in human smuggling. They're going to treat those things very, very differently. And the supply chains, they're going to try and keep open as much as humanly possible, but they're going to certainly restrict the amount of movement of people. So in my humble opinion, a recession is highly likely, but how bad is still yet to be determined. And we're seeing this roll out on a weekly basis. I'm not a property economist. I'm not a market economist, but I can certainly see the indicators. And if I were a betting man, then I guess I'm going to speculate it's probably a 10 to 15% drop in the property market is where I would hypothesize. Now, I note I don't want you to take financial action on that, but what I do want you to do is understand that might be coming. Whether it's 5%, whether it's 20%, I don't know at this moment in time, but know that it is coming. But let's look at the property fundamentals. And this is why what I was talking about before, to say why property always has a lagging effect. Because the fundamentals of the property market are very different to the fundamentals of the share market. So firstly, our property fundamentals are very, very sound. Our population growth is massive. I've been saying this for some time. We're anticipated to grow by another 10 million people over the next 25 years. So with both immigration and births and deaths, that's on average about 400,000 people per year in Australia that need somewhere to live. So our demand is still rising, and that is still going to continue the case whether COVID is here or not. What I would say, with everybody cooped up at home, chances are there's going to be a lot of births in about 9 months' time because everyone's cooped up at home. So our population spike, I think, is going to happen much like it did at the end of the war, when everybody came home from the war, and why the baby boomers are the baby boomers. So supply. Well, the dwelling approvals have been up for some time, and there is some construction under commencement, but I think that the supply right now is actually going to slow down. And the reason why it's going to slow down is because people don't have the money to put into building right now. They want to make sure that they keep that little nest egg handy. So I think any construction that's currently underway will continue, but any new construction is likely to slow. And if that's likely to slow, then the demand is going to keep lifting and the supply is not going to get matched with it, which means that there's a lot of tension that's going to be sitting in that property market. So when it does actually recover, that tension will actually pull that recovery quite quickly, in my humble opinion. From an affordability perspective, we're at record low interest rates. I touched on it before. So at the point where we do start to get that recovery, the ability for people to get into property relatively quick and relatively cheap will be there. The government is putting a whole bunch of, or has been rolling out a whole bunch of infrastructure projects already, knowing that the population growth is coming, and they're putting a whole bunch of stimulus packages in place to keep the economy afloat right now. And I'm going to speculate that they'll put a whole bunch of more incentives once we hit the bottom of this to try and kickstart that the property market specifically. And the property market drives a lot of our economy. So the property market, with construction and housing specifically, and the transacting of those, that is a lot of the supply chain for a lot of Australia. So keeping property alive is going to be one of the things that the government is highly keen on keeping on going. And to the point where I think that the jobs market, whilst they've been closing down a whole bunch of other areas, my hypothesis will be that they'll try to keep the construction industry going for as long as humanly possible. And I predict that they will try to not shut that down early in the piece, and they'll try to drag that out for as late as humanly possible if they have to shut it down at all. So they're the fundamentals. Now, the last fundamental is market sentiment. Now, market sentiment in this particular situation is probably the only thing that's really working against us at the moment. And clearly, market sentiment is low because of what's happening and the media that has been hyping what is happening. So my guidance to you is to make sure that, yes, keep yourself up to date with what's happening, but you want to make sure that you're getting that from knowledgeable sources, not just Facebook, or not just the media trying to beat things up, but actually go to the sources and see what's actually happening. So go directly to the government announcements, go directly to the World Health Organization, go directly to all of those locations and actually get the facts rather than someone's interpretation of the facts. And I acknowledge here the hypocrisy of that, because here I am giving you my interpretation of that. So what I would say is what Warren Buffett says, which is be fearful when others are greedy and greedy when others are fearful. So right now, there's a lot of fear in the market, which means that the market, as I said before, the market is going to drop. There's opportunities that are going to come around the other side. So what you need to do right now is understand where you sit in this position. Are you one of those people who unfortunately are going to be in a tricky spot, in which case plan for that right now to try and minimize the impact of that? If you're in a situation where you may be able to have some access to some resources, then plan for that as well. and ideally plan for both, okay? And I'm going to walk you through some of those things right now. So this is all about getting yourself deal ready. So how do you get yourself deal ready? Well, firstly, you need to assess your current situation. Do not hope and pray. Stay up to date with knowledgeable sources, not media hype. So that's probably the most important thing. Identify opportunities to cut any unnecessary expenses in the shorter term to bring yourself back into surplus. Now, that's to manage your cash flow. Now, there's going to be simple things like, have you got a Netflix subscription? Are you paying too much for your phone subscription? How much are you paying for your internet? All those sorts of things that are very, very tempting to use when you're cooped up at home. But are they necessary at this moment in time? Where can you actually cut expenses from where you are? Know what your break-even point is. So if you know what your income and your expenses are, then you'll know at what point do I actually start to go into a negative cash flow situation. And knowing what my nest egg is sitting in the bank, how long will it take me to actually erode that nest egg before I have to start selling assets? If it's very, very short, then maybe you need to start looking at what do I do with those assets right now before it actually gets to the point where you're desperate. If you've got plenty of reserves in your nest egg, it might be a situation to say, well, can I sit on this and hold, knowing that the market will come back and I won't realize the loss, but I may have some opportunity cost by sitting on my hands at this moment in time. If you own some investment properties, look at any upcoming lease renewals and that sort of thing, and go talk to your tenants. Go talk to them and make sure that the industry that they're in is safe and secure. If your leases are about to be due, see if you can re-sign them up for a lot longer. Knowing that those government incentives are coming, if you don't have a current lease in place, it may not apply if you don't have that lease in place. So that's a conversation that you need to have with those tenants to say, look, I understand that you may be in a position where you might be losing your job pretty soon, but in order for me to help you, or in order for the government to help you and the government to help me, we need to have a lease in place between us. So make sure you go out and actually have that hard conversation as much as humanly possible so that whatever incentive package comes through, you are the most likely to qualify for that. That is quite important right now. So assess your current situation. What are your assets and liabilities, okay? So assets are things that bring money into your pocket, and liabilities are things where money leaves your pocket. So when you're actually having a look at that, and I'll go through a assets and liabilities spreadsheet in a moment, you're going to see how big that nest egg is that you've actually got sitting there. Available equity. So this is cash at hand and equity in other properties that may actually be able to be refinanced. Now, right now, if you're in a household where everyone's still got their job, now is a great time to actually go and get refinance because you've got your income, because you might have that equity sitting there. And that means that you may be able to build yourself a line of credit or a redraw facility or something along those lines that will help you to get through the next little bit. Understand what debt is being serviced. So what have you got that's tax deductible debt and what have you got that's non-tax deductible debt? So if you've got non-tax deductible debt, your principal place of residence or your car or that sort of thing, maybe it's the car that you want to sell rather than sell your property. I would much rather sell a smaller asset and take a small loss on that than try to sell a big asset at a, in a dropping market. So assess those sorts of situations and see, well, what can I do to actually reduce that debt and bring myself into a positive cash flow situation? What positive cash flow do you actually have right now? So any rental income, any share dividends, all those sorts of things. What have you got right now that's actually coming in the door? Make sure you understand how and where they are and any cash flow that you might have from other sources, so wages or profit from projects if you've been doing that. Now, to do this, you could and should have a budget. Now, many people, unfortunately, don't do a budget. So this is a budget spreadsheet that I provide to some of my students, helps them to try and track, well, where is my expenses and where is my income, etc. So we can see quite clearly what their total bills are for a year, and we can see quite clearly what their spare money is. That's going to help them to actually determine their serviceability and also understand at what point they're actually going to get into a negative cash flow situation. If you've not yet done a budget, the time to do that is right now. Go and actually have a hard look at all of your expenses. And if you actually spend on a credit card, you'll be able to look in your bank account and actually see all of those transactions. If you're one of those people who spend cash all the time, you're going to have to try and remember those transactions. So go and actually assess those hard situations and go and see, well, what in the list of things, what can I actually remove at this point in time? What is sacrificial right now that's going to get me through this next little bit? Take a look at your assets and your liabilities. So all of the properties, all the vehicles, all of those sorts of things that you need to look at, including your superannuation. Now, the government has given you the ability to tap into your super if you really do get into troubled times. But my guidance would be, if you can afford not to, then try not to, because as tempting as it is to help you with your current cash flow, it's eroding from your long-term future roadmap. So be very careful there. But we want to have a look at the assets and take some hard decisions and say, are these assets actually serving me I guess, I bought them for a purpose, and I bought them for an investment strategy of some description, or for I guess a lifestyle decision. Are they still serving me for the purpose that I bought them? And is now the time to sell them before everyone starts to panic sell? If you can sell right now, if you have to sell right now, then now is the time to do it, not in a month's time when the market starts to drop. If you can look at those, understand your negative cash flow situation and say, actually, given that maybe I can actually afford to ride the storm out, then you can have a hard look at those and say, well, yes, they're not serving me this very moment, but I know that long-term they're doing okay. So you need to have some very hard conversations about that. Go talk to your finance broker, go talk to your accountant, and have a look at your current situation and see how and where that sits. Also look at your liabilities. So what liabilities have you got that you could actually get rid of, and get rid of as fast as humanly possible? So have you got an asset that you could sell down that's going to get rid of one of those liabilities, for example? So they're the kinds of things that you want to do to see, what can I do to try and cull my situation right now? What that will then give you is an understanding of what your current net asset position is. Now, if you've got some surplus cash flow and you've also got some surplus equity in your properties, maybe you might be able to get a line of credit, or maybe you might be able to get a redraw facility. Now is the time to start to do that whilst everyone in the household actually has a job. If everyone in the household still has a job, even while one person has a job, what can you actually do right now to say, well, if I can just qualify for a small amount of line of credit, that $20,000 or $50,000 that I can get might be enough to see me through this next little bumpy bit. And so if you do that now, before the banks actually get swamped, you've got a higher likelihood of success of that actually occurring. So things to do to prepare: take a longer term view of your current situation. This is going to be, in my humble opinion, a 2-year turnaround from where the market is right now to it dropping and then it coming back. So I think about where we are right now, go down and then come back, is probably at least 2 years away, in my humble opinion. So take a longer term view of your situation and not just look at your day to day, what I'm doing right now, and make decisions based on the longer term, not on the shorter term, wherever humanly possible. Okay. If you're already in a sales phase and you have to sell, and that is assuming that you have to sell, take the money that's actually on the table. Don't get greedy and ask for the last dollar because you think that that's going to be needed. I'm going to say the number of purchases is dwindling, and at this moment in time, they don't have to purchase. And so if you lose the particular person that's a sale right now, maybe that's the one that got away. So don't be greedy and go for the extra dollar. Just whatever, if it's a fair and reasonable offer, and I'm saying if it's fair and reasonable, then take the fair and reasonable offer. If you don't need to sell, then maybe think about taking that property off the market, or don't put it on the market in the first place. The less properties on the market means the less people that are actually going to be panicked. So if you can have that longer term view of being able to hold that asset for 2 years, that would be what I would actually do right here, right now, in order to do that. If you're midway through a deal, and I know a number of people in my network that are midway through a deal, the question to you is, can you afford to pause? What are your holding costs right now? Maybe you've not yet demolished the previous house before you start your construct. If that's the case, can you afford the holding costs? And maybe you just rent the existing property out as is, where is, and take a very small negative cash flow situation rather than go into a very significant cash flow situation and then try to be selling into a very depressed market. Or alternatively, if you're very close to the end of your deal and it's right at the point where it's coming to completion, you want to take a hard view to say, can I actually afford to hold the finished asset and maybe put it on the rental market? And if it's not yet finished, so it's very close but not quite yet, maybe you put it on the rental market right now and sign a lease right now with somebody to say, this is the lease in place for when it does occur, which means that you would then potentially qualify for any government incentives that might come should there be hardship on that rent in the future. So I would be trying to get, I guess, selling a rent roll off the plan kind of thing, even if your project is not yet 100% finished. There's going to be plenty of people who are looking for rental properties in the short to medium term. So go looking for those people. If you're not yet in a deal, I guess this is the point of this particular conversation. If you're not yet in a deal, get ready and get your finance approved. Okay, all of those things that I said before, get your assets and liabilities, do your budgets, all those sorts of things. They are what your bank is going to need in order for you to actually get deal ready. So do that right now. Go get your finances approved. Go speak to your mortgage broker, etc., and get that ready to go. Anything that you've currently got cash in that's not serving you well, what can you do to cash in? So if you've got a second car that you don't need it, do you want to cash that in? Get any approvals for any line of credits or redraws, etc., and then sit on your hands for a little bit. I would say if you can avoid going into a deal today, avoid going into a deal, because I think in 3 months or 6 months' time, there's going to be more deals that start to present themselves as those people start to panic sell and put a whole bunch of stock on the market. Remember, the market fundamentals are still strong. So there's going to be plenty of opportunities where there's going to be deals coming. Now, I want to be very clear here. I am not talking about ambulance chasing. I'm not talking about taking advantage of people who are in desperate situation. What I'm saying is you can find ways to find a win-win situation with that person who is trying to sell. So understand what their cash flow situation is, and if you can help their cash flow, maybe they can give you terms. You might be able to do a no money down deal. Okay, no money down deals are the most likely time you're going to do a no money down deal is in markets like this, markets that are going negative and people want to get the maximum price point they can. In those markets, if they can afford to give you terms, they will, because what they're looking for is certainty. In uncertain times, people are looking for certainty. So if you can give them certainty on price, a lot of people are going to be able to give you, I guess, the terms that you're looking for to get those no money down deals underway. So even if you don't have money right now, go out and start to learn no money down deals. How do I do a no money down deal? How do I do joint ventures? How do I do options contracts? All of those sorts of things that we teach 6 different no money down deals in our community. There's probably a few more out there as well, but my guidance to you is now is the time to start to learn to prepare that. Know that if you can acquire a property when you've got no money and control it. So the difference between owning it and controlling it. Controlling it means that you don't need to put the cash in yourself. So cash is actually required, but it doesn't have to be your cash. If the vendor can stay in the deal, then you don't need to buy the property. If somebody else can fund the deal, you don't need to fund the property. If you can get terms like an option contract, then you don't need to purchase the property. All of these things allow you to control a property rather than actually own it. Start to learn these techniques because now is the time. I'm going to say in the next 3 to 6 months, now is the time where these no money down deals are going to start to become more and more prevalent, and more opportunities actually going to present themselves for you to be able to take advantage of that, even if you are not cashed up right this very second. Then talk to your mortgage broker about, I guess, your current situation and what is the maximum that you can borrow. If you need to go talk to money partners, go start to talk to money partners right now and get them to talk to their mortgage brokers and get the approvals in place right now, whilst interest rates are low and while everybody has a job and whilst there's certainty in the current situation, okay? The next thing to do in the next 6 months, educate yourself. Don't panic. Instead, Warren Buffett has a saying where he says, risk comes from not knowing what you're doing. So if you educate yourself, you're going to know what you're doing. So educate yourself on the market. All the things that I've been talking about today, how and why is the market doing what it's doing, and how and why is it going to recover, and when is it going to recover? If you can actually start to see those market fundamentals and start to see the movements in the market before everybody else is, then you can start to act much faster than everybody else. Educate yourself on your investment strategy. So now is the time to say, well, do I want to be a passive buy and hold person, or do I want to be and maybe pick up some properties that I'm going to land bank for a while, or do I want to be a property developer and force value onto the property? If you're going to force value on, what strategy are you going to use? Is it going to be renovations? Is it going to be subdivisions? Is it going to be units and townhouses? All those sorts of things. All the things that people are going to need once the market does start to recover. Remember that population is still growing. Remember that there's still going to be some tension. So what is the stock that you want to create at the tail end of that? If you're doing a long-term buy and hold, that's a single property that you're holding. If you're manufacturing many somethings, then that's many somethings that are going to go up all at the same time. So this is a perfect time to be looking and educating yourself on those things. Educate yourself on alternate funding regimes. So I've spoken to some of these in previous lives, but there are more than just the banks to get their money from. So there's development finance, there's private finance, there's joint ventures, there's all sorts of things like that where alternate funding is actually available. And no money down deals, as I've actually said to you, no money down deals. So the alternate funding and the no money down deals, the key thing for you to know out of this is your lack of resources right now. And I understand that many of you are struggling, and I understand that many of you don't actually have cash and that you don't have the ability to borrow, but your lack of resources does not stop you from actually becoming resourceful. If you educate yourself right with the alternate fundings, with the no money down strategies, you will, and also knowing what the market is doing and what your investment strategy is, there are going to be opportunities in the next 3, 6, 12 months coming out the wazoo. And whilst you're sitting at home cooped up right now, that is the best time to invest in you and not invest in Netflix. Okay, spend the time to build that knowledge, build that muscle, so that on the tail end you can actually benefit from it. So in conclusion, remember that the fundamentals of the property market are strong in the longer term, and they will actually serve you well. If you can afford to hold, then consider this very strongly against panic selling. Okay, I don't want anyone to be in a situation where they're having to panic sell. It's not good for you, and it's not good for your family, and it's not good for the wider community as a whole. So if you can afford not to, then please don't. There's clearly some downside risk in the housing market, and especially in these highly uncertain times. Okay, there's new policy information coming out every single day as to how and what is actually happening in regards to how the market is going to be stimulated, what stimulus packages are actually coming. So stay up to date with the facts. Don't settle on hype. Okay, so look at the facts themselves. That will serve you very, very well. Property that are less volatile, property is very much less volatile and slower to respond to the market shocks than shares and equities. So yes, the shares have dropped already. The property market has not yet. It will, but it won't drop as much as the share market. So know that that's going to come, but it will also recover with a little bit of a lag as well. So when you start to see the share market start to recover, that's your indicator that you're, or one of the indicators, I should say, not the only indicator, one of the indicators to say that market is starting to turn around and the confidence is coming back. So be prepared to move in and around those times. Transaction activity is likely to be impacted. And as a matter of fact, I've just shown you the statistics on that right now. So transaction activity is impacted right now, but so far that has not yet hit price points. Now I'm going to say that's going to come in the next 3 to 4 weeks time, the impacts on the price points. But right now, it's really just a slowing of the market. So be very cautious with that. So stimulus packages should help to cushion the impact, okay? Now, how much it cushions, time will only tell. I guess the stuff that the government's put in so far is helping people to at least put food on the table. The next round is to make sure that they've got shelter as well. What those things will be right this very second, it's very hard to tell. But I think at the tail end of this, they'll then be putting incentives on to then kickstart the economy as well. So there's going to be multiple rounds of these incentives coming from the government and stimulus packages from the government. As they've said, they've got to plan this out for a 6-month period, knowing that it's going to be rocky, especially in this first little while whilst everything settles down. The current high level of household debt, unfortunately, amplifies the risk of unemployment. So with that, unfortunately, that's going to mean that market conditions are going to mean that some people are going to have to be selling property, because as they get unemployment, if their debt is high, they won't be able to service the property. Unfortunately, that means that those people will be starting to sell, and they will be starting to sell soon. If you are in a position where you know that is likely to be you, the time to do that is now if you have to sell. If you don't have to sell, please hold. Okay, if you can hold, that is going to try and get you out in the longer term. If you're cashed up, then there are opportunities that are coming. And if you're not cashed up, then it's time to educate yourself on how to do no money down deals and how to do those alternate lending strategies. And now is the time to prepare for this. Folks, this is a market that is changing every single day. So for those of you who've not come across the Property Developer Network before, we actually run networking events, and we have been running networking events in our community for the last 8 years. In the current situation, we've moved these to online and virtual events. So with those virtual events, I'll be giving market updates every single time we run an event. We're running 3 of these a month at the moment. We always have industry experts coming in and telling you what is happening in the market in their individual area of expertise. And we also have people within our community sharing real deals, so you actually get to see the good, the bad, and the ugly of a deal. What we're going to do in this time, as I said, I'm going to keep everyone up to date with the market, but I'm going to look at maybe supplementing some of that with some additional information to say, where are the uptakes and that sort of thing for you, and what are the opportunities right here, right now that are happening as we go. So if you're wanting to keep up to date with what is actually going on a weekly basis, then why not reach out and join our virtual meetups. I will, at the end of this, put a post in a link where you can actually go and have a look at where our virtual meetups are. So you can then come and actually join us and keep up to date with what is actually happening in the market. So having said that, I'm going to reach out to see what questions there are actually in here. Give me 2 secs, folks. This is new technology trying to zoom into Facebook. So, well, it's new for me. It's not new in the scheme of things. I can't actually see any questions. I know that they're almost guaranteed to be there, but I just can't work out how to navigate the technology. I'm going to say at this point then, I can't take any questions from the audience because I don't know how to drive the technology. So I am clearly going to have to learn how to do that. So for our next chat, in our virtual meetups, I can assure you that doesn't actually occur. So we can actually interact live as we go. So thank you very much, folks. It's been a pleasure trying to do that. and I'll catch you on the flip side.